Good afternoon. This is Josh here at Chaikin Analytics, and I'd like to welcome you to our presentation of Make Money with Options in a Volatile Market. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics. As a reminder, this webinar is being recorded and a copy will be sent to all registrants tomorrow. Please submit your questions via the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. To get started, here is Marc Chaikin.
Thank you, Josh. People are really tired. So we're going to try and help. And I think the title, Make Money with Options in a Volatile Market, is very appropriate. In case you hear barking in the background, I am doing this webinar from my home office today, and the newest member of the Chaikin community, Scotch, our wonderful Cairn Terrier, is coming back from the vet. So any barking sounds you hear are from our newest Chaikin family member, wonderful companion, and someone who's become very special in just the month he's been with us. My background, for those of you who aren't familiar, years on Wall Street, and for 45 years I've been using technical analysis, but always in conjunction with fundamentals. As we'll see later, fundamentals drive the market. And because I've used technical analysis, pioneered some indicators that you're familiar with, I've survived 10 bear markets. I'm here to tell you, and we're going to cover this in the first phase of the webinar, we are not in a bear market. Can I be wrong? Absolutely. But based on everything I've observed and learned in 50 years on Wall Street, we are not in a bear market. And I'm just going to point out some of the obvious and not so obvious reasons why. Pertinent to today's department at a regional firm called Tucker Anthony and R.L. Day, now part of RBC, 20 branches, tens of thousands of options traders. And in spite of my best efforts, only 5% of those people made money. And I'm going to show you our antidote to what they were doing wrong early on in the webinar. Along the way, I was mentored by some of the smartest and most successful institutional investors. Some of them were colleagues like Stan Burge at Tucker Anthony, who was the first quantitative analyst on Wall Street in the 60s and 70s. Really took me under his wing. I would encourage any of you who are in the position of mentor traders or investors or family members or friends to do it, because it really helped jumpstart my career and put it on the right track. And because of everything I learned from these successful institutional investors, when I came out of retirement in 2010, I was able to create Chaikin Analytics. I was able to fulfill my life's dream. The culmination of my life's work is the Chaikin Power Gauge rating. It's a fundamental multi-factor model that rates 5,000 US equities and now 500 active equity ETFs. And it's the answer to why 95% of people lose money trading options, because you need a directional edge. And as you'll see, the Chaikin Power Gauge rating gives you a directional edge. I'd like to start the webinar with a poll question that Josh is going to put up. What's your biggest stumbling block on the road to options profits? And Josh, you get to share your dulcet tones once again.
Thank you, Marc. You should be able to see the poll. Oh, I see votes coming in. Great. And we'll give it just a few seconds. All right, with over half the votes in, let's share the results. There you go.
Wow, a split between timing and the right option strategy. Well, you've come to the right place, because we're going to start by talking about timing and then along the way speak to option strategy. And all of that should increase your confidence. So these are all interrelated, and believe it or not, the poll results are very, very different for every audience. So let's get right to it and take a look at the market, because the market has been a roller coaster. We went from an uptrend on autopilot in 2017 where we didn't even have a correction of 3%. And believe it or not, people had a hard time making money in 17 because they were bombarded by bearish headlines. And we're going to get into a wonderful headline slide in a minute. But then in early 2018, we went from a correction on autopilot to a roller coaster, from an uptrend on autopilot to a roller coaster of a correction. And we see this is the most actively traded markets, therefore it's really good trends and technical analysis. And what we see we had a big waterfall decline in February of 2018 after the market made a new all-time high in terms of the S&P 500. We rallied up twice and then came back down in March and formed a double bottom. And that double bottom was in the shape of the letter W. And we'll see now in the next slide why that's important, because that first decline exceeded, and as we'll see, beyond 10, almost every action in my lifetime ends in the shape of the letter W. And then we went back on autopilot. I don't think people realize that between March of 18 and the September peak, we had a pretty orderly advance. We ran into resistance at 2,800, and then we broke out in July. Chaikin money flow, which many of you are familiar with on your online brokerage platform, stockcharts.com, measures institutional accumulation and distribution. It's been in the marketplace since 1982. How many of you are familiar with CMF, Chaikin money flow, or the Chaikin oscillator? If you are, in the question box, because that'll help me know whether you're into technical analysis as well as fundamentals. And Josh, just give me a quick read on that, please.
Sure, there are a number of yeses coming in. People familiar?
I need some love. Is it like a majority of yeses?
It's all yeses, actually. I haven't seen a single no yet.
Oh, there you go. Okay, well, Chaikin money flow turned green in May and stayed there till late September. We call that persistency of accumulation. Even on that dip in June, from upper band to lower band, and we use Keltner channels to measure volatility bands. The fact that John prefer the intermediate bands that don't squeeze as much to sort of identify the pendulum swings on the short term. Even on that pullback from 2,800 to 2,680, Chaikin money flow stayed positive. That's a really powerful sign. What did it mean? It meant the institutions were not really contributing to the decline. They were buying into it. And in a sense, a similar thing is happening right now, but not as obvious. So we broke out above 2,800. We peaked at 2,940. And then we started to pull back just like we did in February, and it accelerated. And why did it accelerate? Because someone named Jerome Powell, who's the new chairman of the Federal Reserve Board, got hold of a microphone. He gave a speech on October 3rd and said interest rates were nowhere near where they need to be. They're not near this mystical normal. And the market didn't like that. Spooked by higher interest rates. We broke down, tech stocks broke down. You all are familiar with what's going on. And what we hoped was the first leg of a W, a waterfall decline on heavy volume outside the volatility bands, just like we had in February, just like we had in January, February of 16. Then we rallied up and ran into resistance at 2,800 for the second. That could have been a W bottom right there in November, but we ran into resistance again at 2,800, broke down, made a lower low within the volatility bands. That's when I did a webinar on December 6th and put these question marks in. I felt that a W bottom might be in. But because of the negative psychology, and we're going to explore what that means and how you measure it, rally this time didn't even get above the 21-day exponential average. It peaked there at 26.95. And then today we made a new low. We gave up almost all of the 1% advance off yesterday's 2% decline. We're flying in the face of historical patterns, and that tells me that we're in a fear phase in the market. Now, why are we seeing these waterfall declines? Because there are computer-driven sell programs that have hit the market now for the 5th day in a row. This is a 15-minute chart from stockcharts.com of the S&P 500 cash index. And you can see that since the peak on December 12th, Wednesday a week, midday, the market has just been straight down. And the news headlines on CNBC and the interviews they're doing are skewed to the bearish prognosticators who have consistently been wrong for the last 2 years. Can they be right this time? Sure they can. But we're getting wave after wave of computer-driven sell programs, and this has taken the starch out of the buyers. It's the reason that we've probably got only a 25% attendance rate on today's webinar when we usually get 35% of registrants coming onto the webinar. People are tired. The buyers have gone to the sidelines. But until it changes, all we know is that sentiment is very negative, which is a contrary indicator. So that would lead us to look for bottoms, and fear has gripped the market. Now, let's put pullbacks into perspective. And in fact, we're now in a correction. Pullback is 5 to 10%. There have been lots of them since 1945. They average 6%. They're over quickly. And then you go to new highs. That's why buy the dips, particularly in 2017, was the appropriate way to deal with the stock market. However, when we closed down 10% on the S&P 500, we were now in correction mode. And there now been since 1945. The average decline is 13%. The average length is not 1 month, it's 4 months, but then within 3 months, you rally to a new high. We're now approaching the end of the 3rd month with yesterday's 2% decline. Guess how far we're down? 13%. So none of what we're looking at is abnormal. It's very normal, but it's also very painful to live with. So what we're going to try and address on this webinar is how you can use options to take advantage of volatility, to be on the right side of a move instead of selling out near the bottom because of the headlines. And one more slide reinforces that. This is a chart from Advisor Perspectives that shows you the percentage decline from new highs since the bull market began of March. I'm told that my audio is kicking out. I'm going to try and make an adjustment here. And hopefully that's better, Chris. 10% or more on a closing basis. Now we're into the 6th. Every one of them has ended in the shape of the letter W. And 2 weeks ago, I thought we had formed a W, mainly because the percentage of stocks making new lows 2 weeks ago, we had fewer declines, even though we had made a lower low. That all got out today and got worse yesterday. And that's why I've been saying that we would probably need more time for this bottom to form. And we saw that today. We rallied 1%. Fed meeting is tomorrow. Hopefully Jerome Powell will say something that soothes the market's fears. Don't know. Could do something dramatic like not raise for that last time. But the bottom line is, even though we believe that sentiment is overdone on the downside, this market, based on the technicals, is going to need some more time to form that W bottom. Now, we're still going with our scenario for 2018, and it's going to apply in 19. Higher interest rates, rising earnings. Earnings have been fabulous. Interest rates went up to 326 on the 10-year Treasury, backed off to the 280 area. They're not really a problem when they come in the context of a strong economy and rising earnings. Now, the economy is not going to grow at 3 to 3.5% in 19. That was an outlier based on the new tax laws that were passed in December of 17. But through most of this bull market, we went up with 2% plus GDP growth. Economists, Wall Street strategists believe that's where we'll be in 19, with earnings rising 7 to 9%. That's not bad. As we used to say in Brooklyn, that's not chopped liver. So we still believe that we're in a strong economy. The reality is that economic downturns precede recessions and bear markets. 1987 is the only true bear market I've lived through that wasn't accompanied or triggered by a recession. It was the blow up of something called portfolio insurance that everybody thought was the magic bullet to avoid losing money. The bottom line is we follow 4 indicators. Here are 2 of them. Leading indicators dropped dramatically, reported by the Conference Board before a recession. They're making new highs. And in spite of the bad news in housing, 12-month moving average of housing is also making new highs. So the key indicators like the yield curve and these 2 plus unemployment claims say no recession on the horizon. And guess what? Even if a recession was indicated, the market actually makes new highs in the 7 to 14 or 18 months between when a recession is indicated and when the market peaks. So everything suggests that from a fundamental point of view, going down. That's the headlines in the newspapers and on CNBC. You've got to ignore the headlines to make money in the stock market. Otherwise, you're going to sell out at the low. And that never works because you're not going to get back in and you're going to miss that big first 5 days or 10 days of a move. Earnings move markets, but look at the recent headlines. This is from the New York Times on Sunday. Are you ready for the financial crisis of 2009? Tell me which section of the New York Times you think this headline appeared in. They have a Sunday business section. Do you think this was in the business section? Put a big B in the question box if you do, please. Then Josh, what are we seeing?
Entertainment. One for entertainment.
Good sense of humor. This was in the Sunday style section. I've been on Wall Street for 50 years. When the style editor is talking about a bear market, you know things are a contrary indicator, like putting a bear on the cover of Time magazine. Jeff Gundlach manages the biggest bond funds in America. Very successful. He had a 1-hour interview where Gundlach said U.S. equities are in a major bear market. Get out and buy bond commodities. Guess what? He runs bond and commodity funds. He's been bearish for over 2 years. The market peaked yesterday at 2,600. And the interview started. And then today, Alan Green has a new warning for investors: run for cover. Well, guess what? Alan Greenspan turned bearish with his irrational exuberance. In December of 1996, the market doubled to its peak in 2000. And these people have terrible records, but they are causing fear, panic, and volatility in the market. And CNBC, for whatever reason, is very comfortable featuring this. So you hear analysts like Jim Cramer, who's, I think, a pretty cool head when it comes to this, and David Faber and Barzani on the floor saying, well, the mood is very bearish. People are fearful. Well, no, they're fearful. CNBC is trotting out every bear they can find, and most of these people have a terrible track record. So let's go back to March of 2017. New York Times caution signals are blinking for the Trump bull market. March 30th. The S&P was at 2370. It went to 2940. You cannot make money if you get swayed by the headlines. Fear has gripped the market. We see part of the reason why. And CNN has created the Fear and Greed Index, which does an excellent job as a contrary indicator. As of last night, that index scale from 0 to 100, 5. In extreme for 6, does that tell you? Alone is not enough to turn the market because sentiment is a contrary indicator. But in the end, better to buy when things are extreme fear than extreme greed. In fact, we want to follow Warren Buffett. Investors should be fearful when others are greedy, and greedy only when others are fearful. So the rest of the webinar, we're going to show you how to take advantage of that mantra. We want to find opportunities because the market is gripped by fear. Now, in case you think that the market is in test not just the February lows, which it did today at 25.33, but come very close to a bear market, which would be a 19.99% decline, 360, you could do our favorite bearish strategy, which is a vertical bearish put spread, and buy a put on the SPY with a strike price of 257, which was at the money this morning. Sell a 237.50 put against it. All of these expire on February 1st, so you're giving yourself a lot of time for the market to have that 7% decline that would test the 20% bear market level. And our options play embedded option module we licensed from a great firm called Options Play tells you that this could be better than a 220% return. So if you're bearish, or if you want to do a 401k plan for $5,400, you can protect a $260,000 portfolio. Stay long, protect the portfolio for a 7% decline. Options Play gives us a very high score. It's cheaper than buying the put. That has an 82 score. This has a 137. You've reduced the cost of the put by about 30%. So if you're bearish, or if you want to hedge a portfolio, for $544, you can hedge a $25,000 high-risk portfolio. But let's look at opportunity, because the problem is you've identified as timing, what to buy and when to sell. The solution for us for the last 7 years has been Chaikin Analytics for iPad and desktop. Underlying everything we do, channels drive the market. Here in the last 6 weeks. Emotional market, volatility's up. But for me, the path to profits has always been to combine fundamental technicals. Because we've taken that unique, attracted the support and the endorsement of some really successful people in the stock market. John Najarian, short-term options trader, Jim Cramer, my who provides wisdom every night under the guise of entertainment. There's an awful lot of wisdom there. Forbes, Barron, CNBC, and some of our old hedge fund clients from our institutional brokerage business like Soros, Fidelity, and Paulson. So used by the pros, quoted in the media, it's good validation for what we're going to be showing you. All boils down to the power gauge, our multi-factor model, which shows a very simple display going on under the surface, goes from very bearish to very bullish as a gauge. And as I've said before on these webinars, the Chaikin power gauge display And the power gauge rating is like a Chevrolet with a Ferrari engine under the hood. Power gauge ratings that combine fundamentals and technicals for all active U.S. equity ETFs. And we're expanding that out in February to include all ETFs. Now, the Chaikin power gauge, if you believe that to make money in options or swing trading, you've taken into account fundamentals, the problem very quickly becomes information overload. All those numbers on the right require a lot of knowledge, expertise, and time. And our most precious commodity is time. So what the Clutter, distill all those factors down to the gauge you see on the left for Starbucks, which went from very bearish to very bullish in the last 4 months, 3 months actually. 4 primary factors and 5 sub. These are what institutional value mixer 35 too much for a dollar of revenue, free cash flow to market cap. Earnings per share can be manipulated with accounting techniques. Cash is cash. If you got money in your pocket after a day of selling in the retail business, you know you did business. Earnings growth, very important. Earnings surprise when earnings season surfaces again in mid-January, very important because they drive analyst estimates, and Wall Street earnings estimate revisions are still the single biggest short-term driver of stock price movements. You're seeing it in energy now. They're lowering their estimates in energy. You see it in Apple. Why is Apple going down? Well, part of the reason is they surprised Wall Street and said they weren't going to give out metrics on iPhones, and analysts have been cutting their estimates for the last 6 weeks. And that creates selling pressure. But some of our sentiment indicators are unique: short interest, insider activity. The bottom line is this is an eclectic model. It's not religious. It doesn't just favor value or growth or dividends. It finds a lot of ways to like, and more importantly, not like a company's potential. And so one analyst who's evaluated the model said that the Chaikin power gauge works because it's based on how Wall Street works. It's a reality-based model. It's not theoretical. New PhD throwing spaghetti at the wall, digital spaghetti. That's what got us in trouble in 2008 and in 1998 when a hedge fund called Long-Term Capital blew up, when some Nobel Prize winners built a model for the bond market that didn't work in reality. This model has worked, and let's see some examples of it. Performance. Going back to 99 and the Russell 3000, the average very bullish stock up 20% on an annualized basis. Average very bearish stock up only 1%. That's after a 9-year bull market. Now, part of this is simulated results, but since January of 2011, these are real-time results, and we're going to show you real-world current examples of how the power gauge can help you make money on the upside and the downside and avoid disaster. Because in 2015, the very bearish stocks were down over 17%. These were the energy stocks that net worth. Kinder Morgan, Range Resources, Pioneer, on and on and on. The offshore drill and small caps in general were in a bear market, just like they are right now. And the power gauge rating found them and identified them, just as it's identifying the bearish zeroing in on the bullish stocks. Right now, they're mostly in the defensive sectors, like consumer staples and utilities. I've never been a big fan of utilities because they're a low growth industry, but that's what's working right now. If you want to be long, utilities and consumer staples have been the place to be. Now, I want to give you an example of something we call the class. That's why I love what you're rational, it's not emotional, and you know I use it constantly and almost never want to go against it. So what is a classic bull? It's a stock with a bullish power gauge rating, so the fundamental potential is positive. It's outperforming the market. That's absolutely critical. I'll explain that in a minute. And Chaikin money flow is strong, telling you that institutions are accumulating the stock. Now, we read a chart from the bottom up. This is a one-year chart of Cigna. It became a classic bull in late July. And the reason we read it from the bottom up, that's where the power gauge is. That's your go-to indicator, your directional edge. That's what those 95% of options traders at Anthony didn't understand. You need a directional edge to trade options. Probabilities are lovely, but you gotta know with some degree of confidence where a stock is headed over the next 6 to 8 weeks in order to really make money trading options. Right above that, relative strength, we've converted it to a red-green heat map. Really simple to see if a stock is outperforming the market. And then Chaikin money flow to tell us whether the institutions are accumulating the stock. And then finally, we've got our buy-sell signals, 6 pair in Chaikin Analytics. This is our oversold buy, very simple pattern. I owe this to Larry Williams, who was one of my mentors. A stock that you like makes a new 8-day low and gets oversold. Now, we measure like with the Chaikin power gauge rating. We're not subjective. It's not because my wife shops at Lululemon that I like or dislike Lululemon. It's all based on the 20-factor model. This is a signal that works 2/3 of the time. It's for traders. It has a time dimension of 5 to 10 trading sessions, so it's ideal for swing trading or short-term options trading. Everything you need to know to make an informed decision about a stock, whether you're investing for your 401k or whether you're a swing trader or a weekly options trader, is right here on this chart. Now, the classic bear has become really relevant recently, even though I don't think we're in a bear market. There's been plenty of money made on the downside. And at the end of the webinar, we're going to give you a really special offer for a new publication that our chief market strategist, Dan Russo, is editing called Mastering the Bear. It's a newsletter that we launched on July 1st. Power gauge rating is bearish. Stock is underperforming the market. Chaikin money flow is red, not green, telling you that the institutions are selling. So again, bottom-up analysis. This is Wynn Resorts, one-year chart. Power gauge bearish. Underperforming the market. How do we know that? Relative strength indicator is red. Institutions are selling, and you don't want to bottom fish and get in the way of that avalanche. And then you look for those sell signals. In this case, it's our relative strength sell signal. And I want to explain what that is because it's the most powerful signal in Chaikin Analytics, other than a special pattern with Chaikin money flow that we're going to explain in a minute. If a stock is underperforming the market and rallies above its 21-day average, you're getting a counter trend rally. When it dips below the 21-day average, that triggers a relative strength sell signal. If the power gauge is bearish, that just tells you that the fundamentals are also on your side. The one in the middle of the chart triggered right before an earnings report, stock gapped down and kept going for 3 months to the downside. These signals work 70% of the time. Notice that when Wynn was outperforming the market, the relative strength signals worked on the upside. And the good news is they last 4 to 8 weeks. So you can put on options positions that aren't going to expire in 3 days. You can ride out a little bit of selling at an overbought level and plan your options trades accordingly. And planning is the key. Now, because people are so concerned with the downside, I thought I'd bring in this chart from Richard Wyckoff. We used it in webinars early on, 2-3 years ago. It's an idealized version of how markets break down. The companion pattern is an accumulation pattern. You get a distribution. We're going to see some examples of that with NVIDIA, some other stocks that have peaked like Wynn. You break down, you rally back to the breakdown level, then you get the markdown phase, consolidate, and then a correction to an ultimate low hopefully the market, in terms of the SPY, is now in that final correction phase. The interesting thing is that Wyckoff created this chart over 90 years ago. He was the guru of his day. And the reason the chart works today and the patterns are the same is because human nature hasn't changed. This is all based on human nature. So sum it all up in a pyramid, and then we'll get to some really concrete examples. Successful trading demands a disciplined methodology. If any of you have read Jack Schwager's Market Wizard books, if you have, just let us know by typing a big W in the question box. We're thinking of a special offer sometime in 2019 of offering the book as an inducement to subscribe. Everybody in Market Wizards is successful because they stick to their own knitting. They have a disciplined methodology. Chaikin gives you the directional edge with the power gauge that enables you to build a disciplined methodology that includes fundamentals in your trading. So power gauge rating and industry group strength at the top of the pyramid. Don't have time to get into that in today's webinar, but Josh and our other customer success people show you how to use the industry and sector ETF ratings within Chaikin to point you to the strongest segments of the market. At the bottom, just two technical indicators, Chaikin money flow and Chaikin relative strength. And then for options traders, the real sweet spot are the buy and sell signals, because timing obviously is key. Now, one more pattern, and this is going to recur over and over again in the rest of the webinar. We call it the secret sell signal that 95% of investors never see. Remember, Chaikin money flow has been in the marketplace since 1982. Software packages, put it out there. It's come home 100-fold to me by sharing that. And we call this the Chaikin bearish money flow sell alert. So here's a classic example. Mohawk Industries in the carpet business. Business has been very negatively affected by the bearish home building statistics. Power gauge rating at the bottom and relative strength have been weak since April. Institutions have been selling. And these oversold buy signals have been great opportunities to either get out of a stale stock position or buy puts, or what we really favor, bearish vertical put spreads. But here's the bearish money flow sell alert. It happens when a stock gets overbought and Chaikin money flow, instead of going above the zero line, which it should if there was true demand for the stock, stays green, red or negative. And then it happened again here. Overbought, negative money flow. The king of it was up there behind the labels. Stock made a new all-time high around 280, and money flow was negative. What did that mean? Informed money was getting out of the stock under cover of strength. This pattern has happened over and over and over again for 35 years. You can find these on your online brokerage platforms. Stockcharts.com features this. It's a really powerful pattern, and we're going to see it in the biggest market cap stock of 2018 in a minute. These are powerful signals that help you get out of a stock on strength and not look back. Now, everything we've been looking at, we call the ideal setup. Warren Buffett has famously said that they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. He calls it the fat pitch. We call it the ideal setup. The missing piece are the buy and sell signals. 6 pairs in Chaikin Analytics. You can go to our website, chaikinanalytics.com, and see an explanation of all 6 pairs of signals. We believe in transparency. They're logical, just like that relative strength signal. You've got a stock that's underperforming the market that rallies and then starts back down again, jump on it. That works 70% of the time. Now, we have dashboard alerts in our desktop and iPad apps. So here are my dashboard signals for the S&P 500 this morning. And I see that Mondelez, which I made my bullish stock of the week in Market Insights on Sunday, gave an oversold buy signal. So did Pfizer. There were sells in some semiconductor stocks, some retailers. But people told us, well, we don't always go to Chaikin Analytics every day. How do I know what stocks have signaled? So in May, we responded to that feedback from our members and came out with daily alerts emailed to you at 8 o'clock in the morning that feature the stocks in your list or in a bigger list like the S&P that have triggered buy and sell signals or other actionable events. So on November 9th, in my email, I got sell signals on 2 energy stocks, ConocoPhillips relative strength breakdown and HollyFrontier relative strength sell signal at 65.74. Actually, on a webinar that I did around Thanksgiving, I called that Holly Farms and took a lot of ribbing for it. It's an oil refining stock that had been very strong in Chaikin. Let's look at the chart. HollyFrontier had a bullish power gauge rating and then had a bearish personality change. It went from outperforming the market to underperforming. Institutions were selling, and where you see that yellow arrow, we got that relative strength sell signal, 65.74. Where was the stock this morning? 52.23. I've been using this example on webinars since mid-December. These patterns persist, and this could have helped you avoid a drop in the stock from 66 to 52, or you could have put on a put position and notice there had been, sorry about that, there had been a previous relative strength sell signal up here. In fact, that's the early signal, not this one. Arrow should be moved back to the left. There was a follow-up signal when it rallied from 55 to 61. The original signal was back here at 65.74. Powerful, actionable signals. That's what you need to be successful as an options trader. You need a discipline and you need to know what's happening, when it's happening, so you can jump on it, take advantage of it. Now, what is a personality change? I really think it's the key to making and keeping profit, especially in a market in transition. So spotting personality change is important. A personality change is a stock that goes from outperforming to underperforming the market or vice versa. You don't want to be on the wrong side of that door when Jack Nicholson's coming through with the axe, and you don't want to put your feet in cement and not recognize that things are changing. That's one of the biggest problems traders have. They get stubborn. I've done it. I'm sure you've done it. You can't be stubborn in Wall Street. You got to let the market dictate. So let's look at a recent example of a personality change. Here's eBay. Had a bullish rating in Chaikin electronic marketplace. Big institutional selling, by the way. Another bearish money flow sell alert up there. But the power gauge rating wasn't the only thing that mattered. It was that bearish personality change. Now, right ahead of that, Morgan Stanley turned bullish on eBay in April of 18 at a price of $38 a share, where that yellow arrow is. Then we got the bearish personality change. And after a bearish personality change, we look for the first sell signal to buy a put position or do a vertical put spread. If you're long the stock, it's a great opportunity to get out. Now you can see what happened. There were a whole series of relative strength sell signals starting at about 38, all the way down to the last one, which was at 29. So it's never too late to sell a stock or put on a bearish position if institutions continue to sell, which they have in eBay. Now look what Morgan Stanley did. I don't want to pick on Morgan Stanley. We're going to pick on Goldman Sachs as well. Last week, Morgan Stanley downgraded eBay and cut their price target by 40%. And they said, we were wrong in April. Now, if you're using a discipline like Chaikin Analytics, you don't have to depend on Wall Street research. You can form your own opinions quickly and easily and be a more confident trader. So part of trading well is to minimize exposure to danger and risk. Personality changes, bearish personality changes, alert you to the fact that the landscape has become rocky. So what do danger and risk look like? Well, they look like Whirlpool, which just like Mohawk is in the home furnishings group, appliances in this case, negatively impacted by the housing market, but a classic bear, power gauge bearish, underperforming the market, institutions selling, you want to sell with them. That's what risk looks like. If you can get a stock like this out of your portfolio at 170 on the way down to 100, you spare yourself all the sleepless nights and anxiety of wondering what to do. Now, we have a way to screen for bearish personality changes. Among other things, you can screen for almost anything in Chaikin using the factors in the model plus technicals. In this case, for a webinar I did on December 6th, I was looking for stocks that had recently had bearish personality changes. So I saw Adobe and Amazon, but I zeroed in on the ones with bearish power gauge ratings. Apple and Hess. Apple because it's the most widely owned stock, Hess because it was in the very weak energy group. So here's Apple. Power gauge had been bullish, outperforming the market, and then in early November, you got the bearish personality change here at about 210. And then look what happened. You got a money flow sell alert that actually preceded that at the new all-time high of 230. What do you think should have happened to Chaikin money flow? It had been very strong on the way up to the first peak at 225. You pull back. What was smart money doing in late September regarding Apple? They were selling the stock. Under the cover of strength, big money was coming out of Apple. And then when they reported earnings in late October and disappointed analysts by saying no more metrics, the analyst community soured on Wall Street. You just don't want to do that. It's sort of like a restaurant chef getting on the wrong side of a restaurant critic. Happened in New York in the 70s when I was there. Ironically, that chef, Thomas Keller, left New York, went to the Napa Valley, became the most famous, successful chef in the world at the French Laundry. But he was run out of New York because he got into a verbal fight with the New York Times food critic. You don't want to get into a battle with the people who rate you. In this case, it's the analysts. So Apple, unfortunately, is being downgraded every day. Hit a low here of 162. So you might ask, well, should I be looking to put on a bearish put position in Apple? And we'll address that later in the webinar. It's the last slide we're going to put up. Here's Hess. Underperforming the market, you get that bearish personality change in October. Power gauge was bearish. Institutions were selling. Here's the negative Chaikin money flow. So where did you get your bearish money flow sell alert? Again, right at the high. Chaikin money flow should have been wildly green, indicating that there was buying power behind the move. It wasn't there. I don't like to go short at that point, but I do think it's a great way to get out of a stock. And then, of course, we look for that first sell signal. In this case, it took a while, but it was still a good sell signal. Remember, it's never too late to sell a stock or put on a put position when everything is bearish. Classic bear, all red. That sell signal came at 58, and this morning the stock was 48. It's a good move if you're a put buyer. It's also a good down move to dodge if you were long the stock. Now let's look at Netflix. This is a stock that I'm really bearish on. Power gauge turned bearish in July. The stock was here at around 360. Then we got a bearish personality change and the institution started selling the stock, and we got these two oversold buy signals right under resistance. I think their business model is broken, and the stock has broken down all the way to 250. So you might ask, well, should I be looking at a bearish put position? There was your first sell signal after the bearish personality change. Great spot to have sold Netflix. Well, let's look at what Options Play says about a bearish vertical put spread. I'm going to explain what this is in a minute. You buy a put that's slightly in the money or at the money, and then you sell a put that's out of the money to reduce the cost. So in this case, if you think that Netflix is going from 268 to a new low at 230, buy yourself some time, buy the 270 put, sell the 230 put against it. You reduce the cost of the put from 2275 to 1420. So you're immediately ahead of the game, 33% haircut on the cost of the put. That's why it gets a big 128 with a check mark from Options Play. Roughly 180% profit potential if you get that big drop in Netflix. For $1,420, you can be short $26,835 worth of Netflix through February 1st. You know what your risk is. There are no margin calls. You know your potential. I like to look for 200% opportunities in vertical put spreads. Because volatility spiked up yesterday, option premiums have spiked up as well, so it's more expensive to put on bearish positions. Now, I said we'd look at NVIDIA, which was the best performing stock in the S&P in 2017, made new highs in 18, and let's look what happened when it made that new high around 288. Well, the stock had a double top, and then when it dropped to 260, the power gauge turned bearish on October 5th. Still outperforming the market, but then you had a bearish personality change here in October. But before that happened, Goldman Sachs upgraded NVIDIA to a conviction buy 2 weeks after the power gauge turned bearish at a price of 240. Now, instead of wondering whether Goldman Sachs was right, you're looking at Chaikin and a disciplined approach, and you're saying, I don't care what the best research department on Wall Street says, I'm not going near that stock. And you would have been right because the stock bottomed out at 140. Now, does this work all the time? No, but if you do the same thing over and over and over again, follow the discipline, you're going to be right many more times than you're going to be wrong, and that's going to mean a profitable bottom line and a Schedule D at the end of the year. Now, let's look at some potential options opportunities in a volatile market. For me, volatility and fear equal opportunity if you follow the discipline of the power gauge ratings and the technicals. Use Options Play to find high probability options ideas, and then use rules-based entries and exits. So a very short options primer before we show you some specific ideas. Simplest way to use options: if you're bullish, buy a call option. If you're bearish, buy a put option. I think most of you are familiar with that. What's the biggest problem in buying an option outright? Time decay. Options are a wasting asset. That means that by expiration, unless the stock is in the money, that premium that you pay is going to evaporate. Most people don't give themselves enough time to expiration, and that's where the largest part of the premium curve erosion is in the final 10 days. So we always look to Options Play, which does the work for us, to find options with 30 to 40 days, unless you're trading weeklies, which is a different game. But to take advantage of options premium decay, we like vertical spreads. If we're bullish, we like a vertical call spread, buy an at-the-money option, sell an out-of-the-money option against it. If we're bearish, just the reverse as we saw with Netflix. So one way that you can take advantage of these volatile markets we're in is to look to buy vertical call spreads at the right time on stocks that led the market to new highs. So we're going to look at Amazon, Anthem Health, Salesforce, and Apple, and here's a reveal. Our response is don't be looking to put on bullish positions in Apple. we'll look at a bearish position. So here's Amazon. Came down this morning to 1,500 yet again. Triple bottom, just like the market. Resistance up there around 1,800, right where our long-term moving average and the upper volatility bands are. If you think the market's going to rally, don't know what that impetus is going to be, and Amazon has already cast expectations very low. That's part of the reason the stock dropped when they reported earnings in October. They said, the Christmas season is not going to be that good. Well, Amazon's done this before and then surprised to the upside. So how can you implement a bullish options position? Well, you could do a bullish vertical call spread. The cost of that spread, $8,165. To buy 100 shares of Amazon, $153,500. You can control 100 shares of Amazon for only $8,200. And in this case, the risk-reward ratio is above that 200% level. You're buying the 1540 call, which is roughly at the money, and you're selling the 1800 call against it, reduces the price from 1100 to 8200, so that's a nice discount, gets 107 score. If you want to be long Amazon, but you don't want unlimited risk, this bullish vertical call spread is the way to go in my view. Now let's look at Anthem Health. This stock made a high as recently as 10 days ago. And then Friday, they got sandbagged with the judge in Texas ruled that the Affordable Care Act was unconstitutional. Been outperforming the market, bullish power gauge, making new highs, a Medicare provider. That decision is going to be litigated at least 2, maybe 3 times all the way up to the Supreme Court. Most people on TV who are legal scholars say the ruling is just not constitutional. Bottom line is Anthem may rally back to new highs. So let's see what's possible in a bullish call spread. Well, for $1,266, you could put on a call spread that expires on February 1, but options play is telling you not so fast. The actual put has a red rating, which says don't do it. The vertical call spread doesn't have that nice 100 in green that we like to see. And the return is only 137%. And I said we like 200% potential on these call spreads. So even though the stock's at the lower volatility band, the spread just doesn't have a good enough risk-reward profile. But what you could do, instead of putting on those positions with low ratings, is do what's called a cash-covered naked put. Now, this is a very advanced option strategy for people with a margin account who understand the risks of taking on the obligation to buy a stock like Anthem, in this case, 4 points under the market. This morning, you could have sold a January 260 put that was expires on January 11th, 24 days only to expiration. Obligates you to buy the stock at 260, so you've got to have the money in your margin account to buy 100 shares of stock, $26,000. If it does drop below and you put the stock, you subtract that wonderful rich options premium of $580, and you're buying Anthem at 254, which is 10 points below where it was trading earlier. If the stock goes up, or stays unchanged, or drops to 260, you pocket the premium, which is 2.19%, or 33% annualized. So you either buy the stock 10 points lower, which is a stock you wanted to own anyway, or you earn that very high annualized return on your money. Josh Minlin, who's hosting this webinar, does advanced option sessions for our members at least once, maybe twice a week, and gets into some of these more sophisticated strategies, as well as the more simple call buying or put spreads. So an example of how you can turn high volatility and options premiums to your advantage by pocketing that nice 2.19% return. This is a stock that only yields 1.13%. So in 24 days, you're doubling the yield. do it over and over again, you'll end up buying the stock at some point, but you're going to have a high return on capital until you do. Now let's look at some cloud computing stock that I love. Salesforce.com did not make a new low by a wide margin in yesterday's sell-off and this morning's follow-through. That makes me love it even more. Chaikin money flow is green or positive. The stock is heading toward oversold. Power gauge is neutral, but the underlying fundamentals are strong. So what do I want to do? I want to look to a vertical call spread. In this case, for $600, I can buy the 133 call, which is half a point in the money, sell the 150 call against it. $600, I control 100 shares of Salesforce until February 1. It's 182% return. It's close to that 200% return that we like. And it gets a 99 score with a check mark, but it's a lot better than buying the call, which would cost you almost $800. So it's $200 cheaper, and the return potential is 182 versus 118. Vertical call and put spreads put the probabilities in your favor. Let's end the webinar by looking at Apple. Now, Apple is traded down from 230 to 162 because, as we said, analysts have soured on it. So would we use Apple to play a bottom in the market and a potential year-end rally? The answer is no. And the reason is it's a classic bear. I don't want to put on a bullish position in a classic bear. If it goes up, fine. Let someone else take that risk. So power gauge bearish, underperforming the market, negative Chaikin money flow. So is there a downside opportunity in Apple? Notice that the low of the year is around 150. So you could buy a bearish vertical put spread on Apple by buying the 167.5 put, which was at the money, selling the 145 put against it. Great risk reward profile, 133 in options play, 225% return. But I'm not suggesting that people put on the position. And by the way, everything we talked about is just for educational purposes only. We're not registered. These aren't recommendations, but they're meant to stimulate your options idea process. So I'm not going to put that on because I don't think, in spite of all their troubles, that Apple is going to 145. Based on the chart, it's going to take a real wave down in the market and total liquidation in the stock. I think the stock has already been liquidated. Anybody who wanted to sell Apple has already sold it. Right now, you're left with index funds selling the stock. So even though the risk reward profile is great, I'm going to say pass on Apple. If you want to be bearish, do a spread in a stock like Netflix with a bearish rating where there doesn't seem to be a bottom. And remember, Apple has all that cash, buybacks. Yes, they've gotten on the wrong side of Wall Street, but they'll repair that fence. Tim Cook's a pretty smart guy. So the Apple trade and passing on it is just what Warren Buffett was talking about when he said, you don't have to swing at every pitch. You can wait for your pitch. You're not looking at a fat pitch in Apple, in my opinion, because I don't think the stock is going to go to 145. Now, usually I don't think, I observe, but I just, the selling pressure is off in Apple. So if I'm an options trader, I pass on that trade. I'd rather be long Salesforce or short Netflix or even long Amazon than put on a bearish position in Apple right now. So Chaikin Analytics is what we've been using for our examples. It's a proven stock selection system with options play ideas and daily actionable email alerts. Normally sells for $2,195 a year for an annual subscription. You can go to chaikinanalytics.com/options. But our normal webinar special discount is $400 that reduces the price to $1,795. People who come on the webinar take the time To learn the Chaikin methodology, we like to give you a bonus. But with that comes the screener that you've seen, the Options Play Ideas module, plus member-only access to our weekly strategy webinar with our market strategist, Dan Russo, unlimited coaching by Josh Mindlin and the customer success team, including one-on-one coaching, and Dan Russo's daily morning insights, which have garnered so many accolades I can't even stuff them into an inbox. He just is a pro. He's the head of the Chartered Market Technicians New York City branch. It's been a joy to work with. He's the only person I've ever allowed to write my weekly market insights on Sunday because I have so much respect for the way he thinks. So I'd like to offer you a first fast action bonus. If you join by midnight tonight, you receive 3 months of Dan's new Mastering the Bear newsletter with a specific recommendation every week. We launched this on July 1st. Dan's track record, even before the market went south in this correction phase, has been extraordinary. He booked 225% stock profits plus better than 100% in options profits from each of them just in the last 3 weeks. And when you subscribe by midnight tonight, you'll receive your first Mastering the Bear newsletter tomorrow morning via email. So as a special holiday bonus, call now and save $600 because we'd like to reduce the price to $1,599 for a 1-year subscription to Chaikin. Plus, if you subscribe by midnight tonight, complimentary 3 months of our weekly Mastering the Bear newsletter. ChaikinAnalytics.com/options. I'd like to thank you all for joining us on what was a very stressful market day. Turn it back to Josh Mindlin, who's going to put up the link to our website, to our fulfillment site, where you can subscribe and get the benefit of these bonuses. Josh, back to you.
Thank you, Mark, and thank you, everybody, for attending this evening. In the chat window, I've chatted out the link as well as the number to call. You can reach us at 877-697-6783 or go to www.chaikinanalytics.com/options. Again, you can click on that link right in the chat window. You'll immediately start getting Mark's weekly note and Dan's morning insights note, our chief market strategist, Dan Russo, as well as access to our client success team and all of our archives as well. Again, call us at 877-697-6783 to take advantage of Mark's incredible offer, or go to www.chaikinanalytics.com/options.